Hey, what's up, everyone? Welcome back to Major Hype. I'm your host, Maxwell, where every single day, Monday through Friday, I do a show about money, entrepreneurship, and real estate. And today's no different, even though we're in Jamaica. So let's get started. So our first story tonight is about Starwood Capital Group. They own about 100,000 apartment units. Now, they're one of the largest actual apartment unit holders in the nation, and they also own 1,500 single-family homes. Now, recently a story came out that said that they look to offload about 3,000 of those houses. Now, a lot of people are making this as a post and saying, okay, here is the actual downturn when the hedge funds are starting to unload properties. But I have a different theory, and I think there's a reason why. I mean, they aggressively bought properties in the last 2 years, and they may have overpaid for some of them, as most of you know. If the market is going to correct 10% and they unload these properties now, which is somewhere not completely at the peak of the market, but somewhere near the top, if they could sell these for $1 billion and then come back in 2 years or a year and buy these same properties or type properties that are all mainly located in the southern eastern United States, that they could then have a 10% discount. Now, if you're looking at spending $1 billion, 10% discount is a lot of money. That's $100 million. So if you are the manager of this fund, $100 million is the difference between you making a lot of money or a lot of money, if you get what I mean. So the idea behind this, I believe, is to unload properties in the peak of the market and rebuy if there's a correction. They own 15,000. They're only unloading 3,000, which is quite a bit, but it doesn't, I believe, show a sign of distress from their actual company. I just believe that when they sell these, and they're going to sell to another hedge fund, because who else can afford $1 billion worth of real estate at once? It's going to be interesting. I can't wait to see who actually purchased this. So I'm going to keep my eye on this story. And when somebody does purchase, I'm going to bring you and give you guys an update, because it's important to see who's going to buy these properties. I mean, it's 3,000 of them. And that is an important story, because that's how aggressively these hedge funds were actually buying single family homes in the last 2 years. 3,000 of them they picked up, and they're dumping 3,000 of them to another hedge fund. I think this is a good story. It's an indicator that I'm going to keep my eye on, and it depends who actually buys this. I'm going to report back to you guys and give you an update. Now, there's been a lot of buzz over the last few years of many hedge funds buying real estate. I mean, a lot of real estate. I said before that in January of this year, 30% of the houses that were sold to actual hedge funds. Now, this is going to later down the road have a big impact on home ownership in America. Cincinnati has a different method of approach. See, late last year, about 194 homes came onto the market, a portfolio of 194 homes. Most of these properties were tax delinquent, and they actually had code violations. So this caused an actual frenzy. Basically, if another investor sees that there's issues, these things are going to go at a discount. 194 homes, they could fix them up, and then with rents being as high as they are, they can easily get their money back quickly. The Port of Cincinnati Economic Development Group came in with a bid at $12.5 million cash and picked up the 194 property portfolio. Now, what they plan to do with this portfolio is rent to lower income, middle income people, and keep the home ownership within Cincinnati and not New York and Los Angeles. That's what the CEO of this actual group said. And it's a government agency, believe it or not. But the problem is they inherited about $600,000 in delinquent rent, and 40 of them actually were vacant. So out of the 194, they had $600,000 in delinquent rent, and 40 of them were actually vacant, meaning that they're going to have to put a lot of CapEx into actually fixing these properties up and bringing them up to standard. But the company says they're up for the battle, because their main goal is to get homeownership back into Cincinnati. Now, Cincinnati is a growing market, with its rents also increasing 11% year over year, and its actual home prices increasing about 34%, I believe, which is absolutely insane. Now, Ohio is a market to keep your eye on if you're an investor. City is great, rents are climbing, and it's just a good set of people that live in Ohio. But this is an interesting story. Now you're having cities and government entities actually combating against investors to buying these portfolios. Their thing is they want to keep the money flowing locally. They want to have more home ownership from the citizens of actual Cincinnati and the cities that they're living in. But here's the thing. This was a good portfolio, because this company, the Greater Portland Economic Development, said that they actually go after portfolios like these all the time. They usually call the city and say, who's your top 5 worst landlords? And I want to go after them to buy their entire portfolio. So this $12.5 million investment for them was right up their alley. And with their access to capital funds from the actual government, I think it's going to be a trend that you may see in other cities. So watch out. I mean, us as investors, we go after these type of properties anyways, but now when you go to the bidding table, you actually may have the government bidding against you with tax dollars. With home prices in the United States hitting an all-time high, it makes me wonder what each person in each state has to earn in order to afford one of these houses. Now, at no surprise, you need to make more than $120,000 to buy just the average home in California. Meanwhile, if you're in somewhere like Michigan in the Midwest, you only need to make $40,000. Now, somewhere that is very expensive is Hawaii. As you can see right here, you need to make $153,000 to buy a home, which the average cost of a home in Hawaii is over $600,000. Now, this is insane. As you can see, my state, North Carolina, is $63,000. California is $120,000, which is crazy. And New York, surprisingly, is only $91,000. I guess that averages out when you start to see the entire state. Now, this is based on a 30-year mortgage with a 10% down payment. This goes to show you that you need to make a good amount of money as home prices have continued to grow and grow and grow. As an investor, you may want to look at this map and key in on some of the places that are a little bit more affordable or on the higher end, because it's harder to buy, which means there's going to be more people renting. I would love to know if there's a statistic out there showing how much percentage of home ownership in each state versus rental. I think that's something I'm going to dig up with the team to see if I can bring that to you on tomorrow's show. But it's important to know, like, you got to think in Michigan, there has to be more people owning home and less people renting just because of the affordability, or maybe the wages in those actual states don't match that either, and it doesn't change anything at all. But as you can see, most of these researches come with a lot of variance, so please take this map with a grain of salt. And remember, it looks pretty clear. If you want to be able to afford something, you're going to need to probably get out of these major cities. But don't worry, those home prices are going to keep going up and up and up, and you're going to get appreciation there as well. All right, everyone, this story is good for entrepreneurs. It was one I'm interested in reading, and I'm going to try to find out more because I just love diving deep into someone's mind like this. Well, the founder of Clif Bar, if you don't know what a Clif Bar is, there's the image. Clif Bar, it's like a snack. It's like a healthy-ish type snack that this guy, Gary, invented after a long bike ride. And he'd held the company for 30 years. He had so many offers on his company that he almost lost count, and he had to put on his website that this company's not for sale, so don't ask. Well, just last week, they announced that they sold the company for almost $3 billion. Now, let me put that in perspective. In 2010, Burger King sold for a little over $3 billion, like the entire Burger King franchise. And this guy makes oatmeal bars and sold for $3 billion. Him and his wife own about 80% of this business. This is a cool thing. The other portion was owned by its employees. 20% of the company was owned by its employees. So that means they get 20% of the $3 billion sale, which is amazing. And I think you can learn from this story that if you hold out and you actually take your time and build your company and you have strong beliefs in your company, that would be amazing. It was actually in the year 2000, he had a business partner that wanted to pull out of the business. She wanted to exit, and they had a timely offer for $120 million. They signed the dotted line, and he was about to sign the dotted line, and he pulled out of the deal. And he had to go in debt $60 million in order to pay his business partner off so he could retain the percentage and keep the company private. Well, the payoff, and the one who's laughing is him, because he owns 80% of a $3 billion exit. I think this is an amazing story, and I call this the Super Bowl ring of entrepreneurship. When you're able to sell a company that somebody else wants for a good amount of money, that's a Super Bowl ring in the entrepreneur world. And I'm shooting for that myself. And I hope this story right here inspires you guys to go out and build something that somebody else wants to buy, because that's the ultimate, that's the ultimate Super Bowl for an entrepreneur. All right, our next story may be a little boring, but it's going to be important. Now, there's a lot of people on Instagram and YouTube and all over the place talking about that we're going to have foreclosures and this is going to be 2008. And if you watch this show, you see that I talk about the big difference between 2008 and now. Now, here's another big thing. Right now, delinquencies on mortgages are at all-time low. 2.7%. I'm reading this right now. CoreLogic, who puts out a lot of real estate data, has a lot of nerdy stuff that you guys should go read every single week. Now, last week they put out the delinquency rate on loans. This is loans that are 30 days or more past, right? And so year over year, it's down 2.2%, bringing it down to 2.7%. That's across the entire nation. Only 2.7% of mortgages are actually in delinquency. And the big difference is that the delinquency, that the people that will go into foreclosure, the home prices have climbed so much that will keep these things from going upside down. Very not similar to 2008, where everybody was upside down and basically when they went into foreclosure, their house was worth less than what they actually owed, which was a bad thing. Now, this stat, and we'll leave a link down and below of this story, but it talks a lot about through the entire nation, everything has went down 2.2%. Louisiana has seen some of the biggest decreases at 3%. Mississippi, New York, Oklahoma, and West Virginia have all went down year over year, meaning that last year they had more delinquencies with everything going on in the pandemic, but now everything's down. Well, this is a record low that we're having so far. So this means that behind the scenes, other than prices and the correction coming down from an all-time high, behind the scenes, the real estate inside, is the under the hood, the actual technical side of actual real estate is looking pretty good. Less people are going into foreclosure. Less people are 30 days or more delinquent on their actual mortgage, which means that there's not going to be a bunch of foreclosures. Now, if anything changes in the economy, which the indicators that I always talk about you guys need to do, one of them is consumer confidence. If consumers start to obviously lose their jobs, then yes, there's going to be an uptick on that, but hopefully there won't be. So right now, the healthy inside, like the check engine light, is not quite on yet for the real estate market. I know a lot of people like to talk about gloom, but I'm simply pointing out the stats. Borrowers at an all-time high credit score of 730 versus 2008 when it was below 700. You know, delinquency rates right now only at 2.7% nationwide. So overall, the check engine light is not on the housing market yet, but if it does come on, you do know the signs you need to watch for, do know what you need to be looking for, because right now things are looking pretty good. Now, there is also a map of serious delinquent metropolitan areas, which very common, but there was no change. There was no change in a lot of the cities that you would expect, or that happened in 2008, where there's a lot of people who started losing their homes in California and in New York, a lot of these big markets in Miami. They just don't have the same numbers and statistics to go around. So we're really going to see what happens. So I'm going to leave a link below for this actual story so you can look at some of the boring stuff. But this boring stuff allows you to actually make smart decisions. And CoreLogic is one of the best at putting out this data. So go read this article because it would do you a lot of good. So how many of you have heard this before? Back in my day, or you guys have it so much easier than we had. Now, for some parts, that's absolutely correct. Studies have shown that you have it way harder. It's way more expensive than it was for your parents or your grandparents to actually own a home. Now, home prices are at an all-time high, right? Real estate has been booming for a long time. Over the last 50 years, home prices have went absolutely bonkers. Now, let me give you something that is going to make you just be crazy. The median home value in 1940 was roughly $3,000. And you're probably thinking, okay, how much money did they make? The average salary back then was $940, and adjusted for inflation is about $20,000. Now, let's adjust the price of $2,938 in today's money. That means the homes back in 1940, adjusted for today's market, were only $30,000. That was the median home price was $30,000. Now, if you take it to the 2000s, it's $120,000. We could talk about the wages and everything else and the gap between the growth of inflation. And I know a lot of people have been talking about inflation lately. Inflation. But this story is important because what happened is home prices and home values have outpaced wages and have outpaced inflation by far, meaning that it's more expensive to actually go out and own real estate. So will there be a shift of home ownership to actually rentals? We don't know. Only the future is going to tell. And maybe we're in the beginning of that right now, because I only see in the long term home prices going higher and higher. Now you think about it. If the 1940s, your average home was, $3,000, and now the average home price is over $200,000 in just that short amount of time. I know a lot of people think I'm crazy when I say 1940 wasn't that long ago, but it really wasn't that long ago. So for home prices to go from, $3,000 to $200,000 and adjusted for inflation, going from $30,000 to $200,000, that means home prices are going to keep growing and growing and growing. Americans will become more renters than they are homeowners eventually if we keep up this pace. Now, the only way to fix this, one, slow down inflation, which we don't see that anytime soon. And number two is increase the wages of the actual population so that it can adjust accordingly with at least the inflation portion of this whole aspect, and maybe eventually get to increase towards the actual housing cost. Housing cost is expensive. So you are right. When you sit in your room or you're driving in your car and you say, this is much harder than it was for my parents or my grandparents, you're absolutely correct. Wages have not kept up with the actual home prices since 1940. It's went bonkers. This is a good story. This is something to put in your head, but it also shows you if you invest in real estate long term, you're gonna come out as a winner. The key is it has to be a long-term investment. Get in a house, hold it, rent it, whatever you gotta do, but hold on to real estate because it's proven time and time again that is one of the best asset classes in this world. Hey, what's up guys? I hope you enjoyed this episode of Major Hype. I'm your host, Maxwell. Please don't forget, hit the subscribe button, smash the bell so you know exactly when we're dropping episodes. I'm gonna be in Jamaica all week, so we're gonna be dropping episodes all week here in Jamaica, and some upcoming things is I'm gonna be going to some real estate development projects and speaking to the developer themselves so you guys can get some insight on international real estate. Once again, I enjoy every single one of you guys. Remember, don't forget to comment, hit the like button, and I'll see you guys tomorrow. Peace.